So, something kind of interesting happened with mortgage rates today. And when you dig in, it actually shows a weird contradiction, one that tells us a lot about how financial markets really work. It's a great reminder that the headline, well, it's rarely the whole story. Okay, let's just get right to it. The big number of the day is 6.34%. That is the average rate on a 30-year fixed mortgage. And I mean, whether you're looking to buy, refi, or just keep an eye on the economy, this is a number that really hits home, right? It affects our wallets. And hey, on the surface, this looks great. Who doesn't love to see rates dip? This is technically the lowest we've seen since the last big Fed day. So, time to celebrate, right? Well, maybe hold off on popping the champagne just yet. Okay, so this is where things get a little weird. Because hiding behind that good news is a puzzle, a real contradiction, something that just doesn't seem to add up based on how we think these markets are supposed to work. I mean, you'd think so, right? We all know mortgage rates and the bond market are tied at the hip. When bonds do well, prices up, yields down, mortgage rates are supposed to fall right in line. That's Econ 101 for this stuff. Yeah, but that is not what happened today. The bond market, the very engine that should have been pushing rates higher, was actually a little weaker. So what gives? We've got lower rates on a day when all the signals were pointing in the opposite direction. And this slide just lays the whole puzzle out for us perfectly. On the left, you see how it should work. Weaker bonds mean higher rates. Simple. But on the right, that's what actually happened today. Weaker bonds, but lower rates. That's the head scratcher we're here to figure out. So what on earth is going on? Did someone flip a switch? Is everything backward now? Nope, the answer is actually way simpler than that, and it all comes down to one thing: timing. The secret ingredient here, the key that unlocks this whole mystery, is something called market lag. It sounds fancy, but it's a really simple idea, and it explains exactly why today's rate news can feel so out of sync with what the market is doing right now. So what is this market lag? Seriously, it's just a delay. Think of it like, when you send a text and it doesn't deliver for a few hours? The information was sent, but it wasn't received right away. Well, that's what's happening here. That little delay can create these really confusing moments, just like the one we're looking at. Okay, so this timeline breaks it all down. Let's start with yesterday morning. Lenders put out their daily rates based on what the market looked like at that exact moment. But then, yesterday afternoon, the bonds market suddenly got stronger. That's good news, right? But it was too late. The lenders had already locked in and published their rates, so that good news was kind of just sitting there overnight, waiting. So fast forward to this morning. Lenders are now finally baking in yesterday afternoon's good news. That's why rates dropped. It happened even though the live market today was a little weaker. They were playing catch-up. So here's the big takeaway, the thing you have to remember. The mortgage rate that hits the news today, it's not really about what's happening right now. It's really just a reflection of what happened yesterday. It's always looking in the rearview mirror. All right, so we've cracked the case. But now we've got to put this whole thing in perspective. Because, look, the why behind this rate drop is super interesting, but the drop itself, it wasn't exactly a blockbuster. In fact, the source we're looking at flat out calls the change unremarkable. The only reason anyone is even talking about it is because rates have been moving in this teeny tiny, super narrow range for a while now. So this little dip, as small as it was just enough to technically be the lowest rate in a couple of weeks. And this chart, wow, it really drives the point home. I mean, look at that. We are talking about a move of just 0.02%. Sure, it's a step in the right direction for anyone borrowing money. You can't argue with that. But it's a baby step, more like a tiny shuffle, really. So after all this, you might be asking, why do I care about this little market quirk? Well, it matters because understanding it completely changes how you read the financial news and, more importantly, how you make decisions based on it. Okay, so let's boil this all down. What do you absolutely need to remember from all this? First, mortgage rates always have a bit of a time delay built right in. Second, just because the bond market is going wild this morning, don't expect to see that reflected in your rate quote an hour later. Third, and this is the big one, today's rate is almost always yesterday's news. And last but not least, context is everything. That splashy new low headline could just be talking about a minuscule change. And that really leaves us with one final, pretty important thought. Now that you get this whole time lag thing, you're a much smarter consumer of financial news. It gets you asking the right questions. Not just, hey, what are rates today, but, okay, what did the market do yesterday and what's it doing right now? Because if you think about it, if today's rates are just yesterday's news, what story is the market writing for us tomorrow?